is just sort of broad view of where we are and more importantly, where we're going. And with that in mind, right, as many of you know, and many economists, either claim to or are assumed to have a crystal ball in their pocket given to them upon graduation from economics school. So I was looking for mine this weekend in preparation for this. I actually was off last week. So I was, where did I put my ball? I need some words of wisdom. And I realized that I couldn't find it. I thought, did I leave it at the office? And I remembered, no, I haven't been to the office in a year and a half. Obviously not. Well, it turns out my crystal ball sort of did what a lot of Californians are, I guess, doing nowadays, and decided to move to Nevada. But the good news is all the words of wisdom that I'm going to say today may or may not bring you happiness, but Zoltar has approved them. So with that in mind, here are the 4 questions I want to just, sort of cover quickly, and I'll pause on some of them a little longer than others. How is the economy at this point this year? What are the current drivers of real estate activity in the markets, nationally speaking, and then regionally? How are these drivers actually impacting market activity? And what do we see for the remainder of the year? So let me give you a picture that, we could probably spill a whole book's worth of ink trying to cover. My view in this picture is, what did the economy do in 2020? And you look at this gorgeous picture, and if I'm not mistaken, it's very much of California, very beautiful place. 2020 US economy really fell off a cliff, and that cliff was pretty high up, and the canyon that opened underneath the economy was pretty deep. And as a result, policymakers, monetary authorities, regulators all hurried to build a bridge across this massive gaping canyon between 2020 March, roughly mid-March, to what was initially expected to be roughly 90-day break period as the quarantines took effect. And it turns out that those 90 days turn out into a much longer period. As of right now, the bridge seems to be complete. So 2021, we're actually doing quite well. We crossed the gap by and large, but the price tag for this bridge is pretty steep. It's $5.3 trillion. And so I know that in an era in which we're now contemplating $3.5 trillion budgets and $1.5 trillion infrastructure investments, even in Washington, where money seems to lose its meaning, a trillion here, a trillion there's a lot of money. How much is a trillion? Well, here's a visualization. If you got $1 million in $100 bills, you can pretty much put it in a backpack. If you have 100 million, you're gonna need a forklift. For $1 billion, now you're gonna need a truck. And $1 trillion, well, I think we would have to talk to someone at Amazon about using about 5 of their warehouses to stack this $100 bill. So that's a lot of money. But the balance is, the economy seems to have recovered quite well here at the last 4 quarters of GDP growth. You can tell nice and solid, in fact, higher growth and rebound than we've seen for over a decade. Most of that driven by consumer spending. As you know, GDP comprises 2/3 roughly consumer spending. So all those stimulus checks obviously showed up in economic spending. We'll have to see what the 3rd quarter and the last quarter of this year will look like, given that a lot of those basically have stopped. Importantly, for real estate, employment has been steadily recovering. The bottom line is, we're not quite where we were pre-pandemic. Just look at this, and it's sort of a nondescript chart until you realize the scale of this thing. You have payroll, employment changes monthly. April 2020, we practically wiped out a decade's worth of jobs. So that's been a huge, speaking of gaping holes to climb out of, we're still about 5.5 million short. The good news is, a lot of the gains we've seen over the last year and a half have been in the industries which were initially impacted the most. Leisure, hospitality, retail trade, along with a host of other industries. We're seeing good, solid gains. The trouble is, we have roughly 11 million jobs right now open and unfilled, along with 9 million unemployed Americans. So obviously we have an overlap in the skills, or maybe a lack thereof, with also many people unemployed, still not able to find jobs while companies are trying to hire. This is the weekly unemployment insurance claims. This number is one I've been watching very carefully because it's weekly. Even that has finally returned towards its pre-pandemic lows. We're getting now steadily underneath 400,000 a week, which is a good signal. Consumer confidence showed for the better part of this year the rising optimism. I think that some of the Delta variant of COVID has basically pushed it back a bit, but it still remains at much better levels than it was a year ago. So with this macro background, what are the current drivers from my perspective of real estate activity? I see four. Number one, demographics. Number two, COVID, obviously. Number three, monetary policy. And number four, very important, remote work. And it's something I'm going to touch on every one of them. Briefly, demographics, we have an incredible tailwind, both in the economy, but also in real estate. And I know you're seeing it too. We are at peak millennial demographic cohort. Like, to put a number on that, what does that mean? Consider that last year we had 4.7 million millennials turning 30, sort of the new age for starting families, buying homes, and making long-term investment. It used to be, mid to upper 20s, but with the millennial generation, a lot of the major life decisions were postponed. Graduating school was postponed, getting a job came later, getting married came later. So 30 is the new 20, I guess, for millennials. But on top of the 4.7 million last year, this year we have 4.8 million millennials turning 30, 4.8 next year, 4.8 the year after that, and then another 2 years of about 4.7 million. We're looking at a span of about 6 years in which 30 million Americans are going to turn 30. That's huge. It's huge because demand for housing, from my perspective, will remain healthy, and so will a lot of other macro issues. On COVID, all I'll say is we are clearly working through it. We had a period of improvement. Delta has really thrown us a curveball, but we're seeing the number of cases beginning to decline. And broadly speaking, the economy seems to be making out all right through this. So we'll see where that leaves us come November or December. Monetary policy, extremely important. The Fed has thrown everything in the proverbial kitchen sink at this pandemic, starting with, of course, resorting back to the prior recession's zero rate interest rate policy, though, of course, that doesn't directly impact mortgage rates. But what impacts mortgage rates, and the Fed has played a huge role here, are mortgage-backed security purchases. The Fed making sure that liquidity in the housing finance sector remains an ongoing concern, has been buying mortgage-backed securities to the tune of $40 billion a month. That has absolutely made certain, in addition to private investment, that mortgage rates really saw new records this last year, starting with about midpoint of 3.6% in June last year. 30-year fixed reached 2.6, a little over 2.6 in January of this year, and we've been bouncing around roughly under 3% ever since. Extremely favorable for buying, favorable for homeowners, and obviously has really fueled a lot of the activity we've seen in this year's real estate markets. Remote work, another major driver of activity. Think about, for those of you who remember back, mid-1990s, when the internet became commercially available, and implicit in that genesis was the promise that someday we will be able to work from just about anywhere, including, the much talked about beach. Well, it turns out 2020 was very much that year in which many people actually worked from the beach and other remote locations. What you're seeing here is a lot of home buyers, and this is a survey of home buyers this year we conducted at Realtor.com, say that COVID absolutely has changed how they work, and just as importantly, what they're looking for in a home. And what was interesting to me, we asked these questions both in 2020 in the summer, roughly July. Now that you've been from March till about July, you've been working from home, what do you prefer? At that time, 52% of Americans said they prefer working remotely, already a huge change. We ran the same question this year, and we said, you've been working now for a year remotely. For those of you who have, what do you prefer? 62% of Americans said they prefer working remotely. So an actual increase in preference. And for those of you who may have faced long commutes, I know that for obviously real estate agents, moving around is sort of the constant part of the job. But for people who work in an office, Dealing with 1 hour, 2 hour one-way commutes is something that many people don't miss. And this is absolutely showing up across all generations, as you can tell. And even regions, the West region, where obviously California is located, and shows even higher preference, closing in on 70% for remote work. And what's interesting from a real estate standpoint, we asked Americans in our survey, what do you plan to do if your employer actually requires you to go back? You can tell close to half said, I'm going to make a case for a hybrid schedule. Yeah, I might come into the office 1, 2, maybe 3 days, but I'm going to work from home part of the time. Almost a quarter of Americans said, I'm going to look for another job. In other words, I'm going to quit if they're going to ask me to come back into the office. And when you look across generations, that rate is pretty high for Gen Z, millennials. Surprisingly, almost a third of baby boomers said they would rather find another employment. And companies are really responding to this already. What you can see this slated from the news, not only have technology companies jumped in on the remote work arrangement, but even what you'd consider more stodgy financial institutions like banks and investment firms have recognized the new reality and are moving to accommodate it. So with these drivers, what do this year's buyers really want? And I think you can answer this question even better than I can because you're in the markets every day. But from our data, this is what buyers want nationally. They want a 3-bedroom, 2.5-bath home with, importantly, a garage, updated kitchen, quiet neighborhood, and a large backyard. In fact, we ran a whole host, a long list of attributes we were asked Americans in surveys to tell us what do they want. Interestingly to me, garages are always at the top, no matter the generation or the region, followed by kitchens, obviously locations, backyard. It seems that obviously the pandemic has placed a sharp focus on the fact that we want a little more space from our neighbors. And at the same time, given that we want to work remotely, we need more room. We need flexible spaces that can do many roles. And so these are all showing up. Especially important this year, affordability is showing up in the data as well. You can tell close to 60% of buyers we surveyed this year are looking for homes priced below $350,000. I understand. I just saw the homes you showcased right in San Francisco. Your city is a far distance away from the national median. And so I absolutely recognize this. But obviously, as you can tell, across generations and even regions, affordability is a very important part of most buyers' search. And why are they looking for this affordability? Look back at what I just mentioned. Almost 5 million millennials are turning 30. They're getting married, they're having kids, their families are growing. And you can tell, top reason why people are planning to buy a home this year, they need more space. Interest rates, also an important driver. But as you can tell, number 3, my household is expanding. So obviously, these are all driving a lot of what you're seeing in the market. Same time, this move toward affordability, and you've seen it this year, has literally pushed people to physically relocate. We asked potential home buyers this year, where do you plan to relocate? And as you can tell, about 62% of buyers said they plan to actually leave their current town. 24%, they are looking somewhere nearby, but 21% are planning to cross state lines. And when we asked, what are the reasons you're planning to move? Lower cost of housing came at number 1, proximity to family, friends came number 2, and of course, access to outdoor activities. And don't forget, lower taxes, also very important to buyers. So with these drivers, what are markets showing? And first half of this year, I think we could safely capture in this one slide. This was a story from CNN, which I'm sure you may remember from back in March. There was a home in DC that was listed for $275 grand. It received 88 offers, 76 of those all cash, and ended up selling for $460,000. Right? This was, in my view, almost peak market competitiveness in 2021, and I'm sure you've experienced it in your markets as well. For the second half of the year, what's the main theme from my perspective? And I'll answer it with some data we captured in a survey of sellers earlier this year. We asked sellers across the country, do you plan to bring a home to market in the next 12 months? 10% of American homeowners said they plan to sell in the next 12 months. Why is that number relevant? In any given year, about 8% of homes across America turn over. So this year, we're seeing a 25% increase in homeowners intending to sell. Not surprisingly, many people postponed their plans when COVID struck. So they've been sitting on the sidelines. They're ready to move on. What's important from this data to me, about 60% plan to bring homes for sale, again, nationally, priced at under $350,000. This is very important because this is exactly what a lot of first-time buyers are really pining for a property and have been unable to find it. And when we look at the data on Realtor.com, what you see here are new listings, and you can tell that new listings have been actually rising. We've had roughly a 2.5-month period of new listings coming on Realtor.com rising. Along with that, you see the red line are median listing prices. They have finally entered single-digit territory. We've had a year of double-digit price gain month to month, which peaked back in April, close to 19% year over year. We're now down into more sane levels nationally. And I think this trend will continue. What's important, we just released this piece of research this last week. We've looked at the underbuilding in new home construction over the last decade. And you can tell here what I show you graphed. Household formation, how many people are starting out on their own, versus new construction. Roughly these numbers on a yearly basis tend to be matched. Long-term, about 1.3 million Americans start new households, and new construct builders put up about 1.1 million new homes every year. You can tell that after the last recession, this sort of balance went completely out of whack. The new construction activity has by far been outpaced by new household formation. So that puts us at the end of a decade about 5.2 million homes short. We actually incorporated data through June of this year to come up with the latest number. We're a little over 5 million homes short of where we would normally be given population growth and household formation. To me, that's a huge number. There's no way we're gonna dig our way out of that in a year or two. So with this in mind, where do Americans really look to buy a home nowadays? Based on our hottest zip codes, research we released last month, you can look on this list and notice that none of them include big cities. Most of the zip codes are actually suburban zip codes within close proximity of employment centers. In many cases, they're actually smaller to mid-sized cities, which are within the new commuting time zone, which is roughly 2 hours away. If you look at Peabody, Massachusetts, Concord, New Hampshire, and Manchester, New Hampshire, all of them are within a 2-hour radius or less of Boston. Franklin, Tennessee, within a commuting distance of Nashville. So a lot of affordable places. If you look at the median listing prices, you can tell why they are so attractive. With that in mind, I decided to take a look at a report we put together called Cross-Market Demand and picked San Francisco to see where people in San Francisco who visit Realtor.com, where are they shopping from? So if they live in San Francisco now, where are they looking for their next home? As you can tell, a third roughly are looking within San Francisco. 40%, however, are looking outside of the city within California. And then a little over 30% are actually looking to leave California altogether. And when I looked at the list, within California, you have on your left, you see where they are looking to: Sacramento, Stockton, Vallejo, San Jose, Sunnyvale, and so on down the line. A lot of mid-sized markets, whether it's Modesto, Fresno, Central Valley, seem to have now a lot of attraction given the affordability. And of course, when you look outside of California, along with my crystal ball, not surprisingly, Vegas and Reno are really top destinations, along with Phoenix, Dallas. I'm sure none of these are particularly surprising to many of you. So what are the main issues for the remainder of the year? From my perspective, inflation would have to be one of the items that tops my list of things I'm keeping an eye on, because it's likely to impact most consumers' budgets. When you have to pay more for everything from food to cars to clothing to homes, obviously that's going to have an impact on your purchasing power and economic activity. The Fed still holds that it is temporary. It's not going to be here long. My concern is that given the fact that most companies have to now raise salaries to attract employees, those higher salaries will automatically translate into more purchasing power in the short term. So I see inflation being with us well into 2022, but that's something to keep an eye on. And as for real estate markets, buyers, sellers, realtors, I see an incredible golden window of opportunity in the next 6 to 8 months. Why? Number one, interest rates remain really low. Number two, inventory, nationally speaking, is rising. And number three, given the demographic tailwind, we have an incredible demand ahead of us for the markets for quite a while to come. So with that, I want to wrap my remarks and take any questions. And if you're looking for resources, we have quite a wealth of information from our realtor.com/research portal all the way to our social media and Twitter, where we post daily updates on and commentaries on everything from unemployment to manufacturing, and of course, lots and lots of real estate information. So with that, I'd be glad to take any questions you might have.
Thanks so much, George. That was a lot of information. So yeah, the resources are great. I'm glad Jay has put that in the chat window for everybody. So you can check that out. I mean, I think one of the main questions on everybody's mind is like, what's your thought on the Fed raising interest rates?
Great question and very timely. I don't see the Fed right now being particularly eager to increase rates. Yes, they are worried about economic growth and they're worried about real estate markets, but interest rates are not likely to be their first tool in monetary tightening. In fact, I think they're going to resort to their asset purchases. Two main buckets. Number one, treasuries. They've been buying 80 billion worth of treasuries a month. And number two, mortgage-backed securities. I think they will start cutting back on those two before they'll resort to any interest rate hikes. And myriad reasons for that, but I don't see a rate hike before probably second half of next year. I do see them beginning to fiddle with their asset purchases, possibly by the end of this year, depending on what we'll see this week on inflation, as well as employment on the next couple of months.
Yeah, great. Yeah, that kind of goes along with what I've been hearing, but very interested to hear what you had to say about it. So thank you for that.
So I thought that was totally fascinating to me. So thank you so much for that. I was particularly interested in the working from home driver. It was a little surprising to me to see the consistency across demographic in terms of people who want to work from home. So it's more of a comment than a question. And then a sort of validating point for me, just a very small component of your presentation, was to see that people, in addition to garage spaces, that updated kitchens and bathrooms were also very high on that list in terms of what people are looking for home, which I think is very germane to what we do in this particular market in terms of how we update our homes and present them to sell. So, I mean, all of that was fascinating, but there were certainly components that jumped out for me. We did have a question about getting a copy of those slides.
I can send a PDF doc. The PowerPoint that I use, being that it's so visually heavy, does not fit in anybody's inbox. I have run into that already. So, okay. So I'll turn some of them into PDF and I can email it to Jay or one of you. Yeah, so that way you can send it to the attendees.
We've also
and then Jay, I'm also just seeing your comments. So speak to that.
Yeah, so because we've got today's session recorded, if it's okay with you, George, we're going to put it on our SFAR YouTube page, and we're going to share that out to just our members, but it will be a public accessible link. You and I can discuss that after the presentation today. I thought it was fascinating to see the tailwind from the millennials who should now be looking at buying their first homes. They, of course, have made some of these important life decisions in a delayed way, but I think, if I'm not incorrect, there's a concern that the millennials don't have the same nest egg of money that other previous generations had to get that first home started. Do you have any evidence, or is there any, am I wrong, or do you have any evidence to the contrary or to support that?
Excellent question. And this is something that came out in one of our surveys. We asked first-time buyers specifically, are you having challenges in this year's market? And if so, what are they? The ability to save for a down payment was near the top. And so to me, there's no better answer. I mean, we run these surveys in partnership with Harris. So they are representative samples of adults across the country with thousands of responses. So I have very little reason to doubt them. So when I see that and corroborate that with all the research that's been done on student debt, all the research that's been done on income growth, when just you look at incomes and the level of income growth over the last, make it 20, 30 years even, you'll see that it's been fairly flat when adjusted for inflation, which is not what housing costs have done. So with that in mind, I think, yes, absolutely. The answer is the millennial generation is having a tougher time coming up with a down payment. And when you factor in that many of them don't have high incomes, when you go to a bank to get a loan, and your income is what it is, you're only going to be able to afford so much. And so, not surprisingly, and I think that's the case in San Francisco as well. We have colleagues, of course, in Santa Clara, where we're headquartered, but also in New York and Austin, a lot of other markets. Number one complaint from a lot of my colleagues who have spent the last 10 years in Manhattan or San Francisco building their careers. 10 years into it, they're saying, I still can't afford to buy anywhere near here. So obviously for many of them, and it's been funny to me to see New Yorkers move to places like Nashville, Austin, Atlanta, right? Places which normally would not, surface on any list for anybody who's lived in Manhattan or maybe even San Francisco would not necessarily think, well, I'm just going to up and move to Nashville. I mean, okay, country music is great. The area is fantastic. I lived in Nashville. I loved it, but it wasn't necessarily on anybody's traditional map to move from. So I think that part of the reason we're seeing so much migration toward inland markets is affordability.
Awesome. Thank you.
Oh, great.
Right, thank you. And then Pam, first of all, hey, Pam. I love Pam. Hopefully that answered your question in terms of the recording and being able to share that with your investor clients. So the answer to that question is yes, please take advantage of that. All right, other questions?
Anybody else have a question for George before we let him go?
Really, really fascinating.
Yeah,
really.
great presentation, George.
Thank you so much
for joining us today.
Absolutely, very welcome. I'm glad I was able to join you and see some of the inventory in San Francisco. I need to ask for a pay raise.
Sounds good.
Of all the places you mentioned, I just want to say Austin is a great city. So yeah, they say it's the Bay Area of Texas. So
and the realtor in me is loving that window behind you. So FYI, yes.
So for everyone's benefit, I'll talk to George about getting a copy of the PDF version of those slides, and we may integrate that with our YouTube recording that we'll publish very soon. George, thank you so much for joining us today. It was really fantastic to have you.
Yeah, thanks again.
Certainly, a joy being with you.
And thanks everybody for joining us today. We had a great group today. We had some great listings presented. We're always happy that you guys join us, and we will continue to bring you this program as long as we can. Mark?
Yes. Thank you. We're always welcome recommendations from you for additional topics or guest speakers. So certainly bring those forward if you have them. And thank you so much for coming today.